Ladies and gentlemen, I have Brian Burke on the show today. Very fortunate to have him on. Brian is the president and CEO of Praxis Capital and have acquired over 750 properties, including over 3,000 multifamily units. Brian is also the author of The Hands-Off Investor. Brian, how's it going?
It's going great, Jesse. Thanks for having me on today.
Thanks for coming on. So we were just chatting a little bit there about the book. So is that is hot off the presses?
Hot off the presses. That's right. It's literally just being released for sale right now.
Awesome. And we'll put a link to that, but it looks like you're mentioning it's going to be on the Bigger Pockets website.
Yeah, Bigger Pockets is publishing it. This is the only book I know of that really dives deep into the topic of being an investor in passive real estate syndications, and it seemed like there was a real need to educate the high net worth investor on how to avoid making mistakes when they're making investments in real estate syndication.
There's a varying understanding of what they are and how they work. If you were to kind of take us onto a broad overview of what a real estate syndication is and how that whole structure operates.
Yeah, a syndicate is basically when a group of investors get together to fund a project that's managed by somebody else. And so the practical application of a syndication is where a syndication sponsor, somebody that's in the business of buying whatever type of real estate it may be, whether it's single family homes, apartment complexes, office buildings, skyscrapers, retail strip centers, whatever the case may be, if they're raising money from high net worth investors, family offices, individuals to provide funding for the equity stack, that's a syndication. So basically, somebody goes out, raises money from investors, buys a piece of real estate. That's a real estate syndication. So it's just important that the investors that are putting money in those deals know what they're getting themselves into.
So when would you look at a syndication model as opposed to potentially buying it on your own or going in as a joint venture with somebody, say 50-50 or some structure like that?
Yeah, it's the most people that go into a real estate syndication are people that are just too busy to invest in real estate on their own, or don't have the ability to do it for whatever reason that may be. And there's a long list, and I go into this a lot in the book about reasons why someone would invest in a syndication. And some examples might be, we have a lot of investors with us that work for major tech companies because we're located here in the San Francisco Bay Area. And, these guys are making a lot of money, but they're working, 100 hours a week, and they don't have time to go running around the country chasing down apartment complexes. So for that reason, it's easier for them to invest through a syndication. The other reason for them is that, given that they're very absorbed in what it is that is making them money, they're not absorbed in real estate per se. And so maybe they don't have broker relationships. Maybe they don't have lender relationships. Maybe they don't have the credit, or maybe they don't have the balance sheet to qualify for multifamily financing or commercial financing or whatever the case may be. So for all that variety of reasons, it's easier for them to just invest with somebody else that does this professionally, as opposed to trying to duplicate those results on their own.
So in a syndication, I think basically, for some terminology here, you would be acting in the event that you found the property as the general partner or the sponsor, and this tech guy that's too busy to invest in real estate would be one of the limited partners, as I understand it. And that kind of structure, how do you manage that structure as the GP? I'm assuming different deals will have different amounts of limited partner, different amounts of minimum investments.
Yeah, it's kind of all across the board. And so, we've got here at our company, we have about 3,000 multifamily units spread across, I think, 12 properties. And each of those properties is its own entity and has its own entity structure. So an investment in one property is only invested in that one property, and they aren't invested in the others. That's one structure. The other structure is called a fund, and we have a couple of these as well, where investors would invest into a fund, and then the fund would turn around and acquire a number of assets, whether that might be 2, 4, 100, however many of the case may be. They would invest in a number of properties. So there's two different ways to invest in a syndication, and it could take either of those two forms.
And is there one that just from the operator standpoint that you prefer having the dry powder?
Yeah, from the operator standpoint, the fund is a lot easier. For us, it's more certain to execute. When we go and make an offer on real estate, we know we can close because we know exactly how much money is in the bank or how much dry powder we have to be able to close. We also get the advantage of convincing a seller that we're the one to sell to because we have the capital readily available versus another competitor that's putting in an offer that doesn't have the cash ready and they have to go raise it. So a fund provides us that advantage. A fund also provides the advantage to the investor that they can be invested in a number of different assets with a single investment, and that they might even be investing in a number of different markets. So they might buy the fund might buy 10 apartment complexes in 4 different cities or something like that, where you get that kind of diversification. On the other hand, the single asset syndications offer the advantage that the investor knows exactly what asset they're investing in. They can underwrite that asset and themselves and verify the sponsor's projections and numbers a lot easier because the property is known. They can invest in markets that they really want to invest in and not in markets they don't want to invest in. So there's advantages and disadvantages